Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, and share buttons. Well, it's time to get ready for the collapse. What am I talking about? We've talked about a global economic depression. We've talked about a global financial crisis, but I want to talk about a portion of that today, which is the collapse that is coming in the local and regional U.S. banking sector. So I want to turn, and we're going to talk today about why that's happening. We're going to talk about why it's going to get worse and why the debt ceiling deal that was recently signed is going to make it even worse very soon. So let's turn your attention to this article right here. This appeared in Zero Hedge at the beginning of May. So it may seem, 5 weeks old or so, but I think it's a very good summary of how we've gotten to this point. Because guys, to listen to the media, you would think everything is just fine, right? 2-3 months ago, all you heard about was bank runs. That was in the news 24/7. And now, I don't hear anything. They're not. It's like nothing happened, but we had the second, third, and fourth largest bank failures in U.S. history, all in a period of a few weeks. And it's as if that never happened. Guys, this crisis is not over. The banking crisis it's just on hold right now because they've put some glue on it, some Band-Aids, but it's coming back. So let's read this article, which will tell us give us a bit of a summary on what happened, where we are now, and then we're going to go into why it's getting worse, and then what you can do about it. So it says here, what happened yesterday, and again, this was 5-6 weeks ago, and why regional banks are in trouble. Thus far in 2023, there have been 3 major bank failures, and I do mean major. All told, the 3 banks had $532 billion in assets. That amount is actually greater in size than the combined assets of the 25 banks that failed in 2008. And I know some of you would say, well, in inflation-adjusted terms, it's just higher. No, that's adjusting for inflation so far. The first few months of 2023 have been worse in terms of bank failures than 2008. So it says, what's going on here? Well, what is going on is that the Fed created this mess, and bad risk management at the banks has exacerbated it. Let me explain. Traditionally, banks make money as follows. 1, you deposit money at the bank. 2, the bank pays you a low interest rate on this deposit. 3, the bank turns around and loans out $5, $7, even $10 in loans for every dollar you deposited. And actually, that's infinite now because most people don't realize in 2020 during the pandemic, they suspended the reserve requirements for banks. So they don't have to hold anything. They can just lend however they want. They just make it up. It's a Ponzi scheme, guys. They're just creating this cash out of thin air. It says the bank charges a much higher rate of interest on these loans than the interest rate it pays you on your deposit. 4, alternatively, the bank buys $5, $7, or even $10 in long duration assets. So U.S. Treasuries or other long-term bonds for every dollar you deposited. 5, the bank pockets the spread between the interest it earns on the loans and bonds and the interest rate it pays you for your deposits. This situation works well provided the Fed keeps interest rates low, and of course we know what has happened. Unfortunately for the banks, the Fed unleashed inflation by printing approximately $5 trillion between 2020 and 2022. Bond yields trade based on many things, including inflation, and once inflation entered the financial system, Treasury yields ripped higher, and we see that here. When Treasury yields rise, bond prices fall. So they went out and they bought these bonds, the government debt, the U.S. government's debt. and it paid a certain interest rate. Let's say that's 2%. Well, when interest rates went up to 5, 6%, the price people will pay for that bond goes down because they don't want to buy something that yields 2%. So you have to give them a price discount that gives them the equivalent 5%, 6% yield they get buying them now. It says, so who was sitting on trillions with a T, guys, trillions of dollars worth of long-term treasuries and loans that traded based on long-term treasuries? You guessed it, regional banks. Courtesy of the Fed's idiocy, the banks were destined to be sitting on hundreds of billions of dollars worth of losses on these assets. But it gets worse. Once the Fed finally decided to get off its rear and do something about inflation and embarked on its most aggressive rate hike cycle in history, raising rates from 0.25% to 5% in the span of a single year. And we've shown that chart numerous times this year saying something is going to break. This is the biggest percentage increase year over year in history by far. It's not even close. So he says, why does this matter? Remember how banks pay you a low interest rate on your deposit. Well, who's going to want to keep his or her money in a bank that pays 0.3% at best when he or she can earn 4% or even 5% in a money market fund or a short-term treasury bond, courtesy of the Fed raising rates so fast? And so depositors began pulling their money from the banks, and not by a little. 2022 was the first year since 1945 in which money on a net basis left the banking system in the United States. Let that sink in for a second. The first year since 1945. But hang on. Remember how the bank loaned out or bought $5, $7, or even $10 worth of loans or long-term assets based on every dollar you put in the bank? Well, when you pull your money out of the bank has to unload all that stuff to maintain its capital requirements. So when you go to take that deposit out because you found a better place where it'll earn you a higher yield, you'll get a higher interest rate. Well, in order to meet the regulatory capital requirements, they have to sell these bonds, this debt that they bought that was yielding 2% when they bought it. Well, now it's worth 70, 80 cents on the dollar, and they have to sell it at a loss. And so the Fed delivered the ultimate 1-2 punch to the U.S. regional banking system. The first punch was it ignored inflation to the point that the banks were sitting on hundreds of billions of dollars worth of losses. However, the knockout punch was the Fed raised rates aggressively, which resulted in depositors pulling money out of the banks in search for higher returns on their cash. Now, don't get me wrong, the banks are partially to blame for the fact that they didn't act once the Fed announced it would be raising rates to end inflation. With proper risk management, these banks would have been better prepared for the bond massacre of 2022. However, even careful risk management would have done nothing to help these banks once depositors started pulling their money out. No bank could raise its deposit rates to 4% or 5% to compete with money market funds while staying in business. And so we get this, a situation in which major regional banks are going bust, and the regional bank exchange-traded fund, so this is a composite of a bunch of stocks and regional banks, has lost a third of its value in the span of 6 weeks. Again, this is a few weeks ago. It says the situation is nowhere near over. According to some analysis, half of the U.S.'s banks are currently insolvent. Half. So what is insolvent means bankrupt, guys. It means you can't pay your debts, you can't pay your obligations, you can't meet your obligations. So half of these banks, well, we're not talking about JP Morgan and Goldman and Sachs and these huge banks that are politically connected and will be bailed out at taxpayer expense. We're talking about the local bank near you, these regional banks, the small town banks. Approximately half, according to this analysis, are insolvent. What does that mean? Well, that has huge implications, as we're going to read right here. I'm going to pull this up. This is from Praxis Financial Publishing, and they have a interview here, and we're going to read an excerpt of this interview. It's with former Federal Reserve Bank of Dallas President Robert Kaplan. It says his warnings on inflation and QE were early and right. What worries Robert Kaplan now? And I want to come down to this excerpt right here where they ask a question. Where are we in the banking crisis and how will it unfold? And his response is phase one was an asset liability mismatch at several banks. Alarmingly, 2 of the top 20 U.S. banks, Silicon Valley Bank and First Republic, had mismatches large enough to wipe out substantially all of their capital. They went bankrupt. For whatever reason, supervisory oversight was insufficient to forcefully address at least these 2 highly visible situations. And we talked before about how they're going to say, oh, we need central bank digital currency because that will give us insight into these banks, right? We need 21st century bank regulatory authority over these banks, 21st century regulatory tools in order to oversee these 21st century banks. It's not the 1930s anymore. People don't line up to get their money. They move it with their phone. So it only makes sense that we had this central bank digital currency. That's where they're going to go with this crisis, guys. No doubt about it. But it goes on. He says phase 2 began with the stock market deciding to do its own supervisory scrubbing. It analyzed every bank's hold-to-maturity account and marked to market each bank's stock. In other words, it looked at the balance sheets of these banks. What do they hold? How many deposits do they have that are above the FDIC limit and thus would probably be moved to some of these too big to fail banks? A number of things, and they started repricing these banks. But he says here, we are now heading into the third phase. Bank leadership at small and mid-sized banks are considering how to shrink their loan books in order to address the mark-to-market loss of capital, as well as to guard against potential deposit instability in the future. Bank leadership is very aware that the economy is slowing and that we are likely about to enter a challenging credit environment. And guys, this is very important. We're going to talk about why in just a second. While asset liability mismatches are relatively easy to spot, assessing the quality of loan portfolios is much more complicated. CEOs of many small and mid-sized banks are in a tough position. They can't easily raise equity because their stock prices are down. As a result, they are turning to shrinking their loan books, finding places to pull back on existing loans and future loan commitments. This is making it much harder for small and mid-sized businesses to get and keep their bank loans. It is a quiet phase that won't make headlines, but is nevertheless relentlessly going on beneath the surface. So what are they saying here? They're saying, well, because of the pressure on these local small, mid-sized banks, they're curtailing their loan. They're much less willing to make loans. They may have higher collateral requirements. They're going to be very particular in who they loan to, how much they loan, which means not as much credit is going to be extended to the businesses they serve, which are generally small and mid-sized businesses. Now, why does that matter? Well, it matters for this reason. We see here, this is from NerdWallet. It has some small business statistics, numbers to know for 2023. Here's some generalized numbers about small businesses. Well, 33.2 million small businesses employ more than 61.5 million people, and 66% of net new jobs created since 1996 are due to small business. So let that sink in for a minute. These small businesses, again, they're not being served by JP Morgan, Goldman Sachs. They're small potatoes to those big banks. They go to the banks, the mid-sized, the small banks, where, hey, I'm at the local t-ball game, and the person next to me is the banker and I'm the business person, and we make a deal on a handshake, and our families have been doing business for years. That's what we're talking about here. Well, that supply of credit is going away. And we talked before about the monetary system we have is based on this ever-growing amount of credit. And if that credit shrinks, well, the house of cards collapses. It's just a big Ponzi scheme of IOUs. It requires an ever-growing amount of debt. And so what we're talking about here is when you have people paying off debt, when you have people going bankrupt faster than more credit is being extended, and you have shrinking money supply, that's a bad thing. We're seeing more of that. So I want to take a look at one thing that regional banks also serve, which is commercial real estate. 70% of the commercial real estate in the United States is financed by these small and mid-sized banks. So let's turn and look at this article from Zero Hedge. It says, new poll finds half of major corporations plan to cut office space as commercial real estate turmoil rages on. It says, a few weeks ago, Goldman revealed the most accurate reading of the current commercial real estate market, pointing to a 25% plunge in office property values. Adding more to this nightmarish outlook is a new Knight Frank poll showing that major corporations expect to reduce global office space footprints over the next several years. Guys, they have data on this where if you consider before the pandemic, people would use these security cards and they'd swipe into their office. They'd key into the door to enter their office. That's electronic, so they're tracking that. And if you say that it was 100% before the pandemic, it fell way down low. Well, even now it's only back to 50%, meaning a lot of this office space isn't being utilized, and these leases will not be renewed, many of them. Or maybe your company has 2 floors of an office building and they go, we only need 1 next year. So they get rid of the other one. That's less income coming in for the landlord of that commercial real estate. So it says Bloomberg said the poll of 350 real estate leaders at international firms found half of the largest companies with total workforces of over 50,000 employees are expected to cut their office space footprints by 10 to 20% within 3 years. In other words, as those leases end, they're not going to be renewing them the way they have in the past. The poll signifies downward pressure on office spaces and high vacancies at a time refinancing for the commercial real estate space is more challenging. And we're going to talk about that is an understatement, which could lead to a significant downdraft in property prices. Already, commercial real estate prices have tumbled into a downturn as property values are sliding for the first time since 2011. As for Goldman's most accurate portrayal of current market conditions, their analysts are looking at Green Street data that foretells the coming price plunge in office and apartment property values. And remember, as regional banks began imploding in March, Zero Hedge noted commercial real estate nuke goes off with small banks accounting for 70% of commercial real estate loans. Guys, this is going to be devastating for these regional, small, mid-sized banks that have lent the money for this commercial real estate. To put this in perspective, 1.5 trillion, there we are using a T again, $1.5 trillion worth of commercial real estate mortgages will have to be refinanced in the next 3 years. Of that 1.5 trillion, 88% of those mortgages are interest only. Think about that for a moment. Where have we heard this before? Where have we encountered this before? If you were around 15 years ago when we had the great financial crisis, and we talked about residential real estate, people buying houses and getting these interest-only loans or variable rate loans, and people said, well, what if interest rates go up? And they said, oh, don't worry about it. Or what happens when the interest-only period is over and you have to start paying back the principal? Oh, don't worry about it. We'll refinance and the price will be higher. If we can't afford it, we'll sell it. Well, we found out that prices don't always go higher. And when those people went to refinance and the price had gone down, they could not refinance because they had negative equity. We're going to see the same thing with commercial real estate when these landlords go to refinance these properties, the properties that no longer have the cash flow that they used to have, and that now command much higher interest rates to finance than they did before. They are going to default. And that means who's left holding the bag on that default? Well, who's left holding that are these regional, small, and mid-sized banks, which means that we already read half are believed to be insolvent. What happens is we see the commercial real estate implosion that's financed by 70% of these banks. But guys, it's going to get worse, and it's going to get worse very quickly. This collapse is coming much sooner. And when I say collapse, I don't mean every bank goes under and goes bankrupt, but we're going to see a severe contraction in lending. We're going to see a number of banks go bankrupt. Again, this banking crisis is not over, but one of the reasons we're going to see this flare up rather quickly is because of the debt ceiling deal that was just passed. So I want to turn your attention to this Yahoo article. Well, Yahoo Finance, but it's from Bloomberg. It says $1 trillion Treasury vacuum coming for Wall Street rally. It says, with a debt ceiling deal freshly signed into law Saturday by President Joe Biden, the U.S. Treasury is about to unleash a tsunami of new bonds to quickly refill its coffers. This will be yet another drain on dwindling liquidity as bank deposits are rated to pay for it. And Wall Street is warning that markets aren't ready. So in the past, we talked about this banking crisis was created by people taking their deposits out of the banks because they could get a higher interest rate in these money market accounts. Well, now these people who are buying all this newly issued debt by the federal government will also be pulling their cash out of deposit accounts and buying this debt. It says the negative impact could easily dwarf the after effects of previous standoffs over the debt limit. The Federal Reserve's program of quantitative tightening has already eroded bank reserves, while money managers have been hoarding cash in anticipation of a recession. The sales, set to begin Monday, will rumble through every asset class as they claim an already shrinking supply of money. JP Morgan estimates a broad measure of liquidity will fall $1.1 trillion from about $25 trillion at the start of 2023. So again, here we hear this number, $1.1 trillion. So $1.1 trillion in liquidity taken out of the banking system, $1.5 trillion in commercial real estate that needs to be refinanced over the next 3 years. Trillions and trillions just being thrown around as if at some point this adds up to a real effect on the economy. But here he says, this is a very big liquidity drain. We have rarely seen something like that. It's only in severe crashes like the Lehman crisis where you see something like that contraction. Guys, what does that mean? That means the Lehman Brothers bankruptcy, the collapse of Lehman Brothers in September 2008, which led to a massive decline in the stock market. Many people see that as the big moment of the great financial crisis. And so we're going to be approaching those levels of a liquidity drain in the weeks ahead, just maybe this coming month. It starts on Monday. It doesn't all happen on Monday, but it's going to start on Monday with all of this debt issuance by the government. And it's going to drain the liquidity from banks that are already suffering from so many getting hit from so many different directions. And how can they stand up against that? And guys, what did this article say? It said a shrinking supply of money. And I want to turn your attention to this tweet from Joe Consorti. He says M2 data, again, that's the Federal Reserve's measure of the money supply, was released today. Again, this is not today, it was May 23rd when he put this tweet out. It's down 4.63% since last year, the fastest pace of money supply destruction since January 1933. The Fed eased at 100 miles per hour. Now it's slamming on the brakes, and credit markets are about to fly through the windshield. We've talked about that before, the Fed jacking up these rates so quickly, and the percentage change year over year is absolutely unprecedented. They were going to break something. We're seeing those things break. We've been seeing it for a long time. When we brought that up, we said something is going to break. It's going to happen in the next few weeks. And we saw that with Silicon Valley. It's going to continue. What does all this mean? The shrinking money supply. What does it mean? Well, it means you better be prepared for what's coming. And I'll put some links down below. I'll pin it in the comments. I'll put them in the description to this video, past videos on what you can do to prepare for this. But guys, you need to be preparing, because this is going to cause huge turmoil, not just in the US economy, but in the global economy in the months and years to come, because you can't do this. This when you have a shrinking currency supply, when you have these bankruptcies that take place, when you have these repossessions of office buildings that have lost their value, and these banks going under, guys, that's called a deflationary spiral. It's what we saw during the Great Depression. I believe we're heading into a period of time that will rival the Great Depression in its severity. I don't believe it will last as long as that. But that's what all this means. And there's a meme that's been going around on social media right here. I think it's fitting. It says, everyone's about to find out why their great-grandparents buried money in mayonnaise jars. And I always think it's good to laugh when we talk about some of this bad news. But guys, I'm not saying that you should go out and you should put dollars or euros in a mayonnaise jar and bury it in the backyard. That's not what I'm saying. But what I would say is you need to prepare and be as much as you can like these people right here. What are these people like? These people are tough. They're tough mentally and physically. I'll bet you they had a wide array of skills, and they were smart and wise, and they were survivors. And we need to be preparing like those people for what's to come, because I don't know how much of this we will be forced to endure before Jesus comes back for the church. I don't know. But I know you can see what's coming. And the Bible says when the watchman sees the army coming, he has to warn the city. I can see this coming, and I'm trying to warn all of you to be prepared. Again, I'll put links below to videos where we talked about being prepared, because we just don't have enough time to get into what to do in this video. But guys, this isn't going to turn out well. The system is broken. The very basis, the monetary system, it's broken. The government has been handing out these little pieces of paper, these IOUs. Well, now the bill has come due. They've been doing this for decades, and it's a Ponzi scheme, and it's set to collapse. And that's what we're about to witness, is the collapsing of this Ponzi scheme. And of course, when this implosion comes, right, when the banks go bankrupt, when massive numbers of people are losing their jobs, when they finally recognize that the Great Depression 2.0 has come, the politicians and the central bankers will absolutely panic, and they will do everything they can to stop this. And I believe one of the ways they will is they will say, we will insure your deposits and we will give you universal basic income so that you don't have to worry about how to eat or how to pay your rent. And here it is. It's called central bank digital currency. And guys, central bank digital currency is indistinguishable in its function from what we read about in Revelation chapter 13 in regard to the mark of the beast and the Antichrist and the false prophet and their ability to control who can buy or sell. So I believe they're going to use this crisis. They very well may be intentionally facilitating this crisis because they know the system is broken, the system is collapsing. And so why not give it the push that it needs? Because, hey, we've got the solution waiting in the wings. The solution is the central bank digital currency. And once we can get everybody to walk into that trap, we can close it and we'll have complete control. That's what many of these people are thinking. There are a good number of them that just are clueless, guys. Many of them are just clueless. They're not that smart. But there's a whole lot of people up in the upper echelons of global leadership who understand all of this, and they know that you better take advantage of a crisis, and what better time to roll this out and make people yearn for it than when you have this type of economic collapse. So guys, prepare for this now. Let me know in the comments how you're preparing, or if you work at a bank and you're seeing some of this go on right now, leave your comments below. Let us know what you think. What are you seeing on the ground? How are these things playing out? Do you know people around you that have lost their jobs? Because this is starting to happen already. And again, this banking crisis, it's not something that's coming. It's something we're in the middle of. And oftentimes it's hard to recognize when you're in the middle of something what's happened. But again, the worst year for bank failures, worse than 2008 so far this year. And we still got several months left in the year. And the second, third, and fourth largest banks in U.S. history, second, third, and fourth largest bank failures in U.S. history, I should say. It's only beginning. It's going to get worse before it gets better, guys. And really, the only time it's going to get better is when Jesus comes back. So that's where your focus should be. That's where your eyes should be. Stay in the Word of God. Read your Bible. Prepare yourself. Read your Bible. Focus on your relationship with God, because that's what will get us through hard times. That's what I'll bet these people right here did. I'll bet you they were reading their Bibles and they were focused on God. So, guys, leave your comments below. Make sure to hit the like button, the share button, the subscribe button. When you do that, it helps get this out to more people. But let me know what you think. What are you seeing? Leave your comments below, and God willing, I will see you on Monday. Bye. If you want to learn more about the end times and Bible prophecy, make sure to sign up for my free monthly newsletter and get your copy of my free ebook, 7 Signs of the End Times. Just follow the link in the description to get your free book. Also, make sure to check out all of my books. Just look up Britt Gillette on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.